Hello, and welcome to this in-person Solvency presentation. We appreciate and thank you for taking time out of your busy schedule to come and be a part of this discussion of securing our benefit structure and trust fund. Please know that here at PERA, we are just as invested in the solvency process as you are because it affects our future as well. PERA board members and staff have been working diligently the last year and a half to explore what needs to be done in order to make sure our retirement plan is solvent for years to come. My name is Christina Perea, and I am the Outreach Bureau Chief for PERA, and I am joined today by Wayne Probst, Executive Director of PERA, and Chief Investment Officer Dominic Garcia, who will provide us with more information about the solvency issues we are facing today. So Wayne, I can almost guess the top question we anticipate hearing from members, retirees, and beneficiaries today is how did we get to where we are now, and why are we even having to talk about the solvency of our trust fund and the benefit structure?
Well, those are all very good questions, and I think some of them will be answered in more detail as we go along in the presentation. But I think the important thing to take away from this welcome slide is that the board has actually been working on this issue for now almost 2 years. Back in January of 2017, the board chair at the time, Dan Mayfield, and I think the majority of the board recognized that despite the very positive impact we had seen as a result of pension reform in 2013, that we were still facing some fairly strong headwinds in meeting the board's goal of being 100% funded by 2043 and paying off our unfunded liability by that time as well. So in January of 2017, the board directed our actuaries and staff to work together to put together some educational sessions for the board to address those headwinds that were identified at that time. The board has spent a significant amount of time on these issues, trying to fully understand why perhaps we have not made the progress that we had hoped to after pension reform in 2013. The board also spent a significant amount of time on both our economic and demographic assumptions, making sure that our investment rate of return in particular was realistic and achievable. And they made some important changes to both our economic and demographic assumptions as part of this process. One of the things that of course caught everybody's attention was that in 2018, Moody's downgraded the bond rating for both the city of Albuquerque and New Mexico. Part of the reason for that downgrade was the state's unfunded liabilities for its two large pension plans, the pension plan that covers teachers as well as PERA. And certainly that's something that has gotten the attention of the board, the legislature, and other policymakers, and I think heightened the board's interest in making sure that we were addressing our liabilities and our funded status. One of the things I think that's become very clear from the work that the board has done, and Dominic will talk more about this in a few slides, but it's clear that investments alone will not make up for the shortfall, and therefore we need to look at the other levers that are available to the board to get us back on track to paying off our unfunded liability. The board has looked at a number of possible benefit and contribution structures. They passed a resolution in August reaffirming their commitment to paying off our unfunded liability by 2043. Part of this outreach effort that we're doing right now is to make sure that in addition to some of the ideas that the board has considered, that we reach out to our members, hear from them, hear their concerns, but also perhaps get some ideas from them on how they think we might be able to address the challenges that we face.
For those of you who follow us on social media, you may have seen articles being shared about PERA solvency issues, as well as different op-eds done by PERA board members as well as staff. So Wayne, can you clarify what these articles mean? Especially, I know you mentioned the Moody bond rating earlier. I myself had to look up what that rating meant. So can you go into a little bit more detail about, what the significance is about all of these headlines that have been coming out?
Sure, and again, I think the important takeaway from this slide is that the board didn't just wake up yesterday and decide, well, we need to look at the COLA or look at contribution rates. This has been a systematic and thorough effort by the board, as I mentioned, to understand our liabilities, If we are short of where we want to be in terms of addressing those liabilities and getting to 100% funded, that's what this process has been about, and we have been in the news some. The Moody's downgrade, in addition to getting the attention of policymakers, as I mentioned, it did get some press. And essentially what the Moody's downgrade means is that when Moody's makes a decision on a state's bond rating and lowers it, that increases the cost of borrowing. And that makes it more difficult for the state to borrow money, more expensive for the state to borrow money. In the case of Albuquerque, potentially the cost of borrowing money for the city of Albuquerque and possibly even other cities and counties that issue bonds is higher. And so that's why I think that in particular, that particular headline has been something that has gotten, as I mentioned, the board's attention and is part of small part at least, of what has been driving the conversation. But in addition to that, our board chair, James Maxson, Dominic, and others have tried to make sure that we were keeping our membership informed in terms of how the fund is doing, what we're doing with our investments, and we've had some coverage. We've included some information, of course, in our newsletters on this, as well as social media, as you mentioned. But this is just a few of the headlines about PERA that our members may have seen over the last year and a half.
So when my colleague and I are on the road providing seminars, most members really don't know that we serve a big population. So Wayne, can you explain who we serve here at PERA?
Sure, I'd be happy to. And I want to note for the members of the audience that the slide on the screen is going to be different than the slide in the handout. And that's true of several of the slides that we'll be going through here in a minute. The reason for that is that we actually got updated numbers just this last Sunday from our actuary. We've included them in the presentation on the screen, but we didn't want to waste paper. Once we've gone through all the handouts that we've already ordered, we'll reprint those with the up-to-date numbers. But the numbers on the slide are current as of the end of fiscal year 18. You'll see that for our largest plan, what we call the Public Employees Plan, which includes state police and correctional officers, municipal fire, municipal police, state general, and municipal general, we have approximately 49,000 active employees contributing into the plan. Similarly, on the retiree side, we have close to 40,000 retirees from those divisions, again, municipal general, municipal fire, etc. So these are up-to-date numbers as of the end of fiscal year 18.
So Wayne, you recently mentioned that the Board of Trustees has been working on our solvency issues for the last year and a half, essentially. So has the board, I know that there's several options that they've looked at in order for us to have a solvent plan going forward, but is there any, at the end of the day, is there a certain population of our members that's going to be affected solely, or are any of these changes going to affect everybody in general?
That's a good point. I think I'd start by saying that the board hasn't made any final decisions on either benefit changes or contribution increases, but what they have looked at is a number of possible options. I think the number of packages that the board has actually considered to date is probably 10 or 12. So there's a number of things that they've looked at. But yes, all of those packages would include changes that would affect all of our membership and not just one particular group. We understand that we are an association, and as part of an association, we're in this together. I hope to be a retiree myself someday. And I look forward to that retirement, and we want to make sure that we are preserving it and protecting it for our current retirees, but also our current active members. And also the board has a fiduciary duty to ensure that we protect the retirement fund for people who are not even part of the association yet. So yes, we are looking, and the board has looked at options that would affect all of our membership groups.
To go back to my earlier question, Wayne, why now? Is it safe to say that this image in front of all of us speaks volumes? Can you explain a little bit about everyone, I'm sure, has seen this beautiful iceberg. Can you explain a little bit what the significance of this image is?
Well, as you mentioned, obviously it's an iceberg, and I think it does tell an important story about PERA and why we are here today, and why the board over the last year and a half, 2 years, has been focusing so intensely on our solvency and our long-term projections. When you see an iceberg on the horizon, as you mentioned, it's pretty. It can be awesome, but you also know that there are dangers associated with an iceberg, and that as you head towards an iceberg, you probably want to consider making some course corrections around it to make sure that you avoid it. Of course, this only shows the top of the iceberg, or the tip of the iceberg. I would ask that everybody kind of keep this picture in mind as we go through the presentation, because we'll be coming back to it later in this video. But the top of the iceberg right now shows that our fund value is at about $15.5 billion. Again, the other numbers here have been adjusted to reflect the new valuations that we received this past Sunday. Our funded ratio is at 71.6%. That's down a little bit from what our audience members may be seeing in the presentation and the handout that they have. The funded period for the public employees plan is infinite, and by that it means that the contributions that we are receiving are not sufficient to ever pay off the unfunded liability for the public employees plan. And that unfunded liability stands currently at about $6 billion. That is up from $5 billion approximately at the end of fiscal year 17. So this is sort of what the board has been looking at, the tip of the iceberg. But as I mentioned, as we go into a little bit more detail on some of these issues, I think what is below the tip of the iceberg will become a little bit more clear, and hopefully help people understand why we are having this discussion.
There may be some of you in the audience today where this feels like deja vu all over again, especially if you're around for the 2013 pension reform. So Wayne, I know this graph in front of us depicts what would have happened if we didn't change anything in 2013. Can you talk a little bit more about this graph?
Yes, and as someone who is at PERA, I started at PERA in 2012 and was here in 2013 for passage of pension reform. I certainly can understand the sense of deja vu, but this slide clearly shows that pension reform had a very positive impact on PERA. It's pretty simple. I'm sure those in the audience looking at it understand it, but the red line is the path we were projected to be on prior to 2013 and passage of Senate Bill 27. Simply put, the plan was on a path to insolvency, and by the year 2043 was projected to be only about 30% funded. The blue line reflects our most current trajectory. We are at 71.6%, which is about average for pension plans, public pension plans in the country. And it grows to about 77% in 25 years. We expect when this graph is updated for the board later on, probably in November, that 77% will come down a little bit. I don't think it'll be significant. But the takeaway from this slide, I think, is that the funded ratio right now is fairly stable. This is an example of what one might refer to as treading water. And one can tread water for a long time, but at some point, if you don't start heading towards the shore, you can find yourself in a lot of trouble. And this slide, I think, is a bit of a warning sign for everyone. I think this is part of what, again, the board began to focus on in January of 2017, that we really weren't making the kind of progress we had hoped to, and that there was very little margin for error. And we'll have a slide at the end of the presentation that talks a little bit more about that margin for error. But this is the current funded status, and significant improvement over where we had been if it hadn't been for pension reform in 2013. And I should also perhaps stop here and say that New Mexico is not alone in terms of deja vu. There are a number of pension plans across the country, including our sister plan here in New Mexico for teachers that went through pension reform after the Great Recession in 2008 and 2009, with the hope that that had resolved their funding concerns and put them on a path to being fully funded. Our neighbor to the north, in fact, Colorado, passed pension reform a few years before we did here in New Mexico. They passed pension reform in 2010. I think they had the expectation that that would, again, put them on a path to being fully funded within 25 or 30 years. That's exactly what we anticipated in 2013 here in New Mexico when we passed pension reform. But Colorado, over the last couple of years, has recognized that the pension reform that passed in 2010 wasn't enough. And just this last year, Colorado PERA went back to the Colorado legislature. They passed some additional refinements to the benefit there that affected both retirees and current active employees and future employees. So while these are difficult issues to discuss, and we know there are emotional issues, and there will be legitimate questions as to why pension reform in 2013 didn't entirely fix the problem, we should recognize that we're not the only pension plan in the country that is going through a process of reevaluating after an initial round of pension reform.
So Dominic, this slide shows a timeline of what led us to where we are today. Can you talk about where we are now?
Yeah, Christina. So how we got here to our $6 billion unfunded liability certainly didn't happen overnight. It's really been a story that's unfolded for the last 20 years. And the way I explain it to people is there's really been 4 reasons for how we got here, how we got to this unfunded liability. And the first one kind of starts back into the mid-late 1990s. If you recall back then, being an investment officer, you can invest a simple portfolio in stocks, bonds, and cash, and you would be able to meet 7.25% or even 8% over that time period back then. But at that time, if people recall, PERA was actually near fully funded, if not overfunded. And as you recall, back in that period, returns were plentiful. And so we actually had a push for benefit enhancements. And PERA wasn't alone. This actually happened across the country because people thought returns would grow to the sky and it could pay off any benefit enhancements. But in '97, we did have some unfunded benefit enhancements that impacted the system. And it really what it was is it increased the multiplier for our pensioners. So that was reason one. Reason number 2 is that, shortly thereafter, we experienced 2 very big drawdowns within a 10 to 15 year period. The first, if everybody would remember, is the dot-com bubble. And then the second was a Great Recession, which was a very impactful drawdown that we experienced as a pension system, not only us, but across the country. But in particular for us, that was a especially poor period of time. So when you actually take into account those 2 big drawdowns, our 20-year return was about a 6.5%. It's not bad, but it wasn't quite at the actual return that we needed. So that brings us to the third reason. And that third reason is over that entire 20-year period, we paid out fixed COLAs at about 3%, and then since 2013 at 2%. So we paid out those fixed COLAs, what I would refer to on the credit card, meaning we didn't quite fully earn those dollars over that 20-year period, or didn't quite earn that money and put it in the bank, but we paid it out nonetheless. So we paid them on that credit card. Fourth is over that entire period, well, we pay a high level of contributions in our system. In fact, we're probably have one of the highest contribution rates in our system. We weren't paying at the total cost of the benefit. So it was those 4 things that led us to where we're at today over that 20-year period. It was those benefit enhancements because we thought returns would grow to the sky in the 90s. And it was the dot-com and Great Recession that impacted returns, but yet we continued to pay fixed COLAs on our credit card, but didn't have quite fully the amount of contributions coming in at the cost of our benefit. That got us to roughly where we're at today of our $6 billion unfunded liability.
So Wayne, I know you and Dominic have mentioned a little bit about our liabilities earlier in the presentation. For those of us in the room who may not know what a liability is, can you explain what that means and also just speak more about who our liabilities are here at PERA?
I think another way of explaining liabilities is liabilities are sort of like promises. And this graph demonstrates the promises that we've made both to our current retirees as well as our current active employees. Overall, we've promised a little over $20 billion in benefits. 70% of that is for people who are already currently retired, and 30% is for current active employees paying into the system. This is an illustration of what one of our board members has said is our math problem. It's very difficult for 30% to cover the 30% who are currently contributing into the system to cover for the 70%, almost 70% who are already receiving a benefit. This is not to point fingers at any one particular membership group, but it is a very graphic illustration of our overall liabilities, and that the majority of our liabilities are with our current retirees.
And Wayne, if we wanted to continue the conversation about our retiree population, especially because it's our biggest liability, which happens even that our retirees are retiring really young, that's pretty significant, correct?
It is. The benefit that we offer for both for current retirees as well as future retirees is very generous. One of the characteristics of it is that historically, and this didn't just happen yesterday, but historically we've had a fairly young population of retirees. And if you take that liability that we just talked about in the previous slide for our current retirees and break it down even further, you'll see that the majority of that liability is for retirees under the age of 65. It's not uncommon for us at PERA to see people who retire at age 55 or 57. We see people from time to time that retire as young as 45. That, of course, is a great benefit for those who have it, but it does put a strain on the system and is part of the challenge that we're facing now in terms of our unfunded liabilities and our funded status. The PERA benefit is one of the most generous public pension benefits in the country. I would say it's probably top 3, and it may even be top 1. There are very few pension plans anymore that offer the multiplier rate percentages that we do, fixed COLA, allow people to retire at any age with 25 years of service or 20 years of service in the case of public safety. But this is just a little bit more of a breakdown of the current liability owed to our current retiree population.
So for those of you who may have watched one of our earlier recorded presentations that's on our website, Dominic, you mentioned that this slide is probably the most important slide of the whole presentation, correct?
That's right, Christina. I think if our members really want to study one slide, this one really speaks volumes. We refer to it as a little bit of a pig in the python, but it's a confusing slide, so give me a second to describe it. And I think if we go back to the analogy of the iceberg, what we're really talking about is under the water here. This is what really the slide is. It's that mass of the iceberg that's under the water. And what it shows is our cash flow, our projected cash flow all the way out to 2047. And we are a mature pension fund, and what that means is that we pay out more in cash flow than we actually receive in. And in numbers, that means we pay out something around $1.1 billion a year in benefits, but we receive about $600 million in cash flow. And what that turns out to be is about a minus 3.75% negative cash flow, which is shown here on this graph. And it's also in the green, which means that negative cash flow is actually healthy for the system. We're okay, we're in a good spot. But there's 3 lines that move from that negative 3.75% out over time. And let me focus just first on this purple or the middle line that shows that over time, and say over the next 15 to 20 years, that cash flow burden actually grows from about minus 3.75% to about 5.5%. And that gets into this pink area here that we show as an uncomfortable or not healthy spot for the association. And why is that not healthy? It's because that becomes a high burden of negative cash flow that we're paying out, to a point that we might have to start getting more from the corpus of the fund than what is necessary. And that's just based off of our baseline projections that we meet 7.25% returns year over year over year over the next 15 to 20 years. And let me explain. So the green line is a very good scenario, meaning that we produce returns above 7.25%. But that's a low probability. Actually, that's a 25% or less probability that we can actually do that. And the blue line is actually a bad scenario that we produce returns less than the 7.25% return. And as you can see on that bad scenario, we actually get into a very, very strenuous and difficult spot for the system. We get to a dangerous spot, frankly, for the system and a cash flow expectation. So as you can see, we call this the pig and the python because it's really that past liability, those past liability streams that we've talked about over the past 20 years that are really coming due. It's those things we put on the credit card that are really coming due and passing through the system for the next 15 to 20 years. This is what we need to manage through. And so any solutions that we come to in the system need to make sure that we're managing this cash flow, that any bad outcomes we can sustain and weather through. Any bad economic or investment storms, that we have a system and our cash flow can weather through that. But this picture shows that mass under the water and that pig and the python that we have to manage through.
And before we move on to the next slide, I just wanted to reiterate something that Dominic mentioned. This last year, we paid out $1.1 billion in pension payments, but we only took in $600 million in contributions from active employees. Again, that's not uncommon for public pension plans. We can manage that type of a negative cash flow, we think, going forward prudently. But as the previous slide demonstrated, if we begin to experience a greater cash flow a shortfall than that, we could find ourselves in a very serious situation very quickly.
I barely became knowledgeable about the Consumer Price Index, Dominic, also known as the CPI. But for those who may not know about the significance of the CPI, can you talk more about it?
Yes, Christina, and we get a lot of questions from members about the COLA and the CPI and how we paid it out. And what we're showing here is really just the data of CPI over the last 20 years. And CPI is really the federal government's, and actually it's the Bureau of Economic Statistics, or the Census Bureau's calculation of what cost of living is in the country year to year, and it's a pretty detailed calculation. But it's the most widely used and accepted calculation of consumer prices. And so what we showed here is kind of the growth of that year by year over the last 20 years, and also the COLA that we've paid out over the last 20 years. And as members would recall that basically from 1997 to 2012, we paid out a fixed COLA of 3%, and then since then we've been paying a fixed COLA of 2%. But if you take those two things side by side, the amount that we've paid out to the average retiree in those fixed COLAs has actually exceeded or outpaced the CPI by about 32%. So on average, the PERA retiree over that 20-year period got a COLA that was better than CPI by that amount.
So when we provide presentations on the road, it becomes pretty apparent that most of our members don't know that we actually have 31 different retirement plans. And with those retirement plans are contributions. Can you talk a little bit more about the significance of the plans along with the contributions and why they're so important in this discussion?
Well, we've already talked quite a bit about the cost of living adjustment and its impact on our unfunded liabilities. We've talked about the amount of liabilities or the percentage of liabilities that are for current retirees. This focuses a little bit more on contribution rates for current active employees, and I think that is fair that we not only focus on what the liabilities and the impact of current retirees, but also us who are still in the workforce. And this sets out the contributions by division within the public employees plan. As we've already indicated, there are 5 divisions. There's a state general division, state police, municipal general, municipal fire, and municipal police. And I'm going to focus on the columns to the right of this slide. And what we've show here is, and what we are often asked, and I'm sure you're asked as well when you're out on the road for PERA, is, well, if we have a shortfall, can we make it up by increasing contributions? And that's a very fair question to ask. So we have analyzed that, and this is information that our actuaries prepare each and every year. And again, this is updated information and the numbers here will be slightly different than those on the handouts that people have. But take, for example, the state general division for state employees. You'll see that despite, as Dominic has already mentioned, contributions being high for PERA, in fact, we do have some of the highest contribution rates for both the employer and the employee in the country. It would take about another 11.7% for the state general division, 11.7% in contributions for the state general division to be 100% funded by 2043. So an 11.7% shortfall in contributions. You go down, you'll see that state police and correctional officers division, they're in a different situation. In fact, they are already 100% funded, over 100% funded. So we don't need additional contributions from state police and correctional officers. And in fact, there's about a 28% surplus in contributions that we are receiving from our members in that division. For municipal general, it would take about another 1.6% increases in contributions in order for the municipal general plan to be fully funded by 2043. You'll see that division has a amortization period of 43 years. That means at current statutory rates, it would take 43 years for the municipal general division to pay off its portion of the overall unfunded liability of $6 billion. An amortization period is very similar to a mortgage. Most mortgages are 30 years, so if you have a 30-year mortgage, you're expected to pay it off within that period of time. Similar here, the goal is for all of our divisions to be able to pay off its unfunded liability within that 30-year period. Municipal police, it would take about a 6.4% increase for that division to be back on track to being fully funded by 2043. Municipal fire, almost a 16% increase in contributions. And for PERA total, if you average everything up, it's about 5.7%. So I think the important takeaway from this slide is that we have now 3 divisions, state general, municipal police, and municipal fire that are in an infinite funding period, again meaning that with current statutory contribution rates, they can never pay off their portion of the $6 billion unfunded liability. Whenever a division gets into that category, it raises a red flag in terms of administering the plan. And so again, I think this slide demonstrates that the contributions alone are probably unlikely to be increased to such a level that our divisions that are underfunded can get back to being fully funded by 2043.
One of our biggest criticisms that we've been hearing, Dominic, in this process thus far is why can't we invest our way out of this? Can we catch up by putting all of our efforts into investing?
Well, Christina, before I address that question, I think it's first important to look back to history of what we have actually done in investment returns. And in this slide actually depicts that. And so I'm going to really kind of talk about the history of our returns in kind of 3 ways. First, let's really focus on the 5-year number here on this slide. And this is really post pension reform in 2013. So since then, we've averaged about a 7.3% return net of fees. That's actually been above our expected actuarial return of 7.25. So we've met that number since pension reform. And as I referred to previously in other slides, our 10-year number has been below that. And a lot of that was the Great Recession. And in particular, our experience in the Great Recession was poor. And a lot of that was led by a big concentration of stocks that we had going into the Great Recession. And I'll talk a little bit more about that in a second. But let's really look at long run, 30 years. 30 years, we've made about a little over 8.5%. That actually has exceeded our actuarial return over that time period. So in the short run, we're meeting our numbers. It's in that intermediate term with the Great Recession. We had a difficult experience, and the drawdown of that has been an impactful for our returns. But over the long run, we've been able to meet those return number, the actual targeted returns. So that's a little bit of what we've done in history. So now let's talk a little bit about, well, why can't we make up the shortfall? Why can't we make up that unfunded liability? And it's really on the next slide that really discusses that conversation. So people ask us, can investments make up for all the past? Can we make up for that $6 billion unfunded liability? Well, the board and staff have actually studied that question for at least the last year and a half. We've listened to our own in-house experts and consultants, but also we brought in additional experts from PIMCO, Wells Fargo, Bridgewater, other firms to talk to us about the investing environment over the next 10 years. And the strong consensus amongst experts, both in-house and outside in the industry, is it's going to be a very difficult 10-year period for returns in any asset class going forward. And so we actually took the liberty of calculating out what we actually need to catch up to make up for those returns, for those unfunded liability. We estimated it would require about an 11% return over the next 10 years. And in that difficult low return environment that we expect over the next 10 years, it becomes a very low probability for us to make that up. So what we've actually calculated is at our current portfolio, to make an 11% in this difficult next 10-year environment, it'd be an 11% chance or probability, a very low chance. You know, and over the next few years, working with the board, my staff and I are looking to enhance our portfolio just for the chance to get to our 7.25% expected return. But to even when we get to that enhanced portfolio, the probability of making up or catching up for our unfunded liability only gets to about an 18% return. So I think the takeaway is a couple of fold. One is experts agree that it's going to be a very difficult return environment over the next 10 years. It's going to be a challenge for us just to get to a 7.25% return. For us to even have a chance to get to an 11% return to make up for all that unfunded liability or those past ills over the last 20 years, it's a very high bar and a low probability that we can expect to actually accomplish that feat.
So Dominic, I'm sure you've been getting this question recently, but why can't we take more risks with our investing?
I do get this question all the time, and it's really a question of how much risk do you really want us to take with your money? You know, people say, can't you just go all in on the stock market, take more risk, and you can make up for it? We actually showed in this graph, we kind of did a simulation of what if we did take more risk in the portfolio. In fact, we actually increased our risk in this simulation to about 50% more to affect what would happen if we went all in on the stock market. And the outcome is our drawdowns become much greater. And we've circled about 5 different drawdown periods, but I really want to emphasize the global financial crisis. If we went through that again by risking up, by being all in on the stock market, our fund would lose more than half of its value. In fact, we'd be more than $2.5 billion worse off than if we just kept our well-diversified portfolio that we have today. And so risking up, going all in the stock market, actually brings us closer to risk to ruin. It actually brings us closer to insolvent if we see another big storm in the marketplace.
So Wayne, when I first saw this slide, even just the terminology, market volatility, the graph in general, I didn't understand. Can you just explain what this graph means for all of us today?
Well, it's very similar to a graph that we saw earlier in the presentation, but it also, I think, is a good visual example of the iceberg that we've been talking about, and that we have to be cognizant of not only what is above the water, but also what is below the water. What this is, the blue line shows our current kind of treading water status. We're at 71.6% funded, and if we hit each and every one of our assumptions, including a 7.25% return every year between now and 2043, we'll probably be in the area of 75% funded, so not a whole lot of progress. But what we did is we asked for analysis of what if during just 1 year between now and 2043, we missed our 7.25% return and instead had a 0% return. And I think we all know that at some point in the next 25 years, there will with almost certainty be another recession. There will certainly be very good years in the market, but there are also going to be some years where we don't hit 7.25%. But if we just miss that 7.25% for 1 year, you see that our funded ratio begins to decline fairly significantly. And instead of being about 75% funded in 2043, we're only 60% funded in 2043. We've also run the same analysis if we had a negative 5% return. We've ran the same analysis if we had the kind of return that we had negative return that we had during the Great Recession in 2008 that Dominic has talked about. And the picture gets pretty ugly pretty quickly. So while it might seem from the blue line that things are okay, this is sort of the lessons learned slide. Have we learned our lessons from 2008? Have we learned our lesson from other years when investment returns were below expectations? And can we manage for those situations? This is an example of stress testing the fund to see what it would do in some years that aren't particularly what we are currently expecting them to be. By now, I'm sure people are maybe tired of hearing about the iceberg, but I promise this is the last time that we'll talk about it in this presentation. But this is the same picture from one of the earlier slides, only now you see what is below the water line. And that is really what we're trying to avoid, because if you're just seeing the tip of the iceberg, again, it looks perhaps manageable. Unless you're Captain Smith, you can navigate around it. But the PERA board, I think, has been focused not only what our current situation is, but also some of the challenges that we could be facing in the future if we don't properly manage our benefit structure and our contributions and our investments. So that's really a wrap up for this presentation in terms of what the board has been looking at, what our concerns are, and why we are here today talking about our pension and the need for possible course corrections to ensure that we not only avoid the tip of the iceberg, but we avoid what is potentially below the waterline.
The PERA board looks forward to ongoing discussions related to ensuring the long-term solvency of the benefit that we offer to current and future retirees. The board encourages you to continue your participation in this dialogue and invites you to follow our efforts by visiting PERA's Solvency Information webpage and our social media pages. Please also feel free to contact PERA board members as well. PERA board members and staff appreciate and value what you have to say as active members, retirees, and beneficiaries. Thank you.